Stanley Black Decker delivered a massive beat on profitability for Q2 2026, and it sent the stock gapping up in pre-market trading. Total net sales came in flat at $4.0 billion, though organic revenue did manage to, eke out a 3% gain.
Right, yeah.
But the real story was on the bottom line. Adjusted earnings per share crushed consensus, coming in at $1.57, while GAAP EPS printed at $2.33.
Huge numbers.
Yeah. Management immediately capitalized on that momentum too, raising their full-year 2026 adjusted EPS guidance to a range of 5.2 to 5.80, and they bumped up their free cash flow forecast to between $600 million and $800 million. So today, our mission is to put on our financial analyst hats and distill this really dense earnings report into the core takeaways for you as a retail investor.
Exactly. Because if you just stop reading after that flat $4.0 billion revenue figure, you're going to completely misunderstand this quarter.
Oh, totally.
The top line looks like a company that's just, treading water. But the underlying profitability metrics show a manufacturing operation that is being aggressively, almost ruthlessly restructured from the inside out.
Okay, let's unpack this, because you're looking at the adjusted gross margin, which hit 33.7%.
Yeah.
For context, for you listening, that is a 620 basis point jump year over year, which is massive. It's like waking up to find out your heavy-duty, gas-guzzling pickup truck is suddenly getting the mileage of a hybrid.
That's a great way to put it.
Right. But a 620 basis point expansion for a legacy manufacturer, that doesn't just happen by asking the assembly line to work a little faster. Where exactly did all this new efficiency come from?
What's fascinating here is that it actually breaks down into two distinct buckets.
Okay.
The first bucket is pure, grinded-out operational execution. Management calls this gross productivity and favorable product mix. And then the second bucket is a very specific structural financial event involving net tariff refunds.
Interesting.
So let's tackle the operational side first, because that is the permanent architectural change to the business. When we say gross productivity, we're really looking at supply chain transformation and footprint actions.
Break those terms down for us, though, because footprint actions sounds a lot like corporate jargon for firing people and closing buildings. Is that basically what we're talking about here?
Essentially, yes, but it is entirely about consolidation and efficiency. Think about it. A legacy company like this, they acquire dozens of brands and facilities over a century.
Right.
So you end up with this sprawling footprint where you might have, say, 3 different 1980s-era factories all making similar components, and they're all running at maybe 60% capacity.
Which is incredibly inefficient.
Exactly. So a footprint action involves shutting down the 2 older, less efficient plants, taking those severance and relocation hits up front, and then moving all that volume into one modernized, highly automated facility that's running at 95% capacity.
So you are eliminating all that duplicate overhead, the extra factory lighting, the redundant middle management, the overlapping logistics routes.
Precisely. And then you combine that with a supply chain transformation. Instead of buying raw steel or, plastic resins from 40 different regional suppliers, you consolidate your purchasing power globally to negotiate steep bulk discounts.
Makes sense.
You start reshoring certain components to reduce transatlantic freight costs. Every single penny squeezed out of that manufacturing process lowers the cost of goods sold. That operational rigor, that is the bedrock of the 370 basis points of core margin expansion we saw this quarter.
Got it. But 370 basis points isn't 620.
Right.
That leaves a roughly 250 basis point gap. And you mentioned that second bucket was a structural financial event regarding tariff refunds.
Yeah, specifically refunds related to IETA tariffs. And it's important to note, we need to look at this strictly through the lens of corporate finance and balance sheet mechanics.
Right. Keep the politics out of it.
Exactly. Tariffs, at their core, are simply a variable cost of goods sold. When a company imports a component, they pay the duty, and that cost hits the income statement, which naturally depresses the gross margin.
So when the government retroactively refunds those tariffs, how does the accounting actually work? Do they just get a giant check that boosts revenue?
No, it doesn't boost revenue at all. It artificially depresses the cost of goods sold for that specific quarter. They get the capital back, which causes the gross margin percentage to suddenly spike.
Ah, okay.
And management is being entirely transparent about this. They're saying 250 basis points of that 33.7% margin is a one-time structural benefit from those refunds.
It's an injection of capital.
Exactly.
Yeah.
But it isn't repeatable operational efficiency.
Right. That makes total sense. It's a great windfall, but you can't build a long-term business model on retroactive refunds. The core operational improvement is what actually matters. But, knowing they're building tools more efficiently only tells half the story. We have to look at who is actually buying these tools to understand that favorable product mix you mentioned earlier.
Yeah, the segment data shows a very deliberate shift toward higher margin buyers. The heavyweight division here is the tools and outdoor segment.
This is your DeWalt, Craftsman, Stanley tools.
Yep, all the heavy hitters. They pulled in $3.56 billion in net sales, driven by 3% organic growth. But the key driver wasn't just casual weekend warriors in the retail channel.
Okay.
It was sustained demand in the U.S. commercial and industrial channel.
So why is that commercial channel so crucial? Is it just pure volume, or are professional contractors buying a fundamentally different type of product than, say, the average homeowner?
It is entirely about the type of product. Think about it. A homeowner might buy a basic 12-volt drill and use it twice a year to hang a picture. Right. And the margin on that consumer drill is razor thin. But a professional trade worker, an electrician, or a framing carpenter, they are buying into heavy-duty 20-volt and 60-volt brushless power tool ecosystems.
Oh, wow.
Yeah, they are buying heavy rotary hammers, high-capacity lithium-ion batteries, heavily engineered job site equipment.
Because it's their livelihood, they wear the tools out, they constantly need replacements, and I'd imagine they're willing to pay a massive premium for durability.
Exactly. The demand is incredibly sticky. Retail consumer spending can fluctuate wildly based on interest rates or just general housing sentiment. But large-scale commercial construction projects, those operate on multi-year timelines.
So they have to keep buying.
Right. When you sell into that professional channel, you are moving high-ticket items with substantial gross margins. That is the favorable product mix in action. It props up profitability even when your total volume is technically flat.
Now, here's where it gets really interesting, though. That dynamic is clear in the tool segment. But when we look at their other major division, the engineered fastening segment, the numbers look like a misprint.
Yeah, they do.
Total net sales in fastening plummeted 18% down to $396 million. Yet, their own presentation claims organic revenue was actually up 3%. Wait, if organic growth is up in fastening, where did the 18% total drop come from? Are they just shrinking the company on purpose?
They are absolutely shrinking the company, but it is a highly calculated strategy. It's known as strategic pruning.
Okay.
The 18% drop in total revenue looks alarming until you realize that Q2 was the first full quarter without CAM.
CAM being Consolidated Aerospace Manufacturing.
Correct. They sold off that entire aerospace division back in April. So when you remove a massive division from your books, obviously your top-line revenue takes a huge dive.
Right.
But management isolated the core fastening business. They actually retained the parts focused on automotive and industrial markets, and those specific retained segments outperformed the broader market and grew 3% organically.
But wait, if the aerospace division was generating revenue, why sell it? Why willingly sacrifice the top line like that?
Because revenue does not equal profitable growth.
Ah.
If a division requires immense capital expenditures, highly specialized labor, and constant R&D just to maintain a mediocre profit margin, it drags down the entire enterprise.
That's just a weight around their neck.
Exactly. Aerospace manufacturing is incredibly complex and capital intensive. By divesting it, Stanley Black Decker is basically saying to the market, we are a tool and industrial fastener company. We shouldn't be tying up our balance sheet trying to build aerospace components.
They're shrinking the overall footprint to focus exclusively on what they do best, and more importantly, what yields the highest margin.
Precisely.
And we are seeing this exact same philosophy applied to their outdoor equipment, too. The report highlights they are transitioning their gas walk-behind mowers to a licensing model.
Yeah, and that is a perfect example of capital efficiency. Think about the logistics of manufacturing a gas-powered lawnmower yourself.
It sounds awful.
It is. It requires sourcing small internal combustion engines, bending heavy sheet metal, dealing with oil and spark plugs.
Right.
Then you have to box up this massive, heavy product, ship it across the ocean, and store it in vast warehouses before it finally makes it to a hardware store floor.
The freight and warehousing costs alone must be astronomical compared to, shipping a pallet of cordless drills.
The margin profile is terrible. So rather than tying up their valuable factory space and working capital building mowers, they are shifting to a licensing model.
Okay.
They will allow a third-party manufacturer to build the mowers and just slap the Stanley Black Decker brand on them.
Oh, wow. So they just collect a royalty check. Zero inventory risk, no factory overhead, pure margin falling straight to the bottom line.
Exactly. It
Yeah.
allows them to redirect all of that freed up factory floor space and supply chain bandwidth toward manufacturing those high-margin, high-voltage battery tools we talked about earlier.
Which brings us to arguably the most critical question for any retail investor looking at this stock today. Selling off a major aerospace division and restructuring product lines that generates a mountain of cash. And management didn't just let that cash sit in a checking account, they deployed it incredibly aggressively this quarter.
The capital allocation strategy in Q2 was highly decisive. Following the CAM divestiture, they immediately reduced their debt by an astounding $1.7 billion.
That's a massive number.
And simultaneously, they repurchased roughly 3.2 million shares of their own stock for about $250 million.
So what does this all mean? I have to push back on that debt reduction just a bit. $1.7 billion is a ton of capital. If management is so confident in their operational turnaround, why not pump that money into R&D to invent the next generation of power tools? Or, I don't know, buy a smaller, high-growth competitor. Paying off the corporate credit card feels like a really defensive move. Is it really the best use of cash?
If we connect this to the bigger picture, in this macroeconomic environment, it is the most offensive move they could possibly make. Yeah. When a company sells a massive asset like CAM, the absolute worst thing management could do is let that cash burn a hole in their pocket and go make some bloated, overpriced acquisition just for the sake of top-line growth. By deploying $1.7 billion to pay down debt, they are prioritizing an investment-grade balance sheet.
Walk us through the actual mechanics of how that benefits the shareholder, though.
Sure. So corporate debt carries an interest expense, right? Every quarter, before the company can report a single penny of net income, they have to pay the interest on their bonds and commercial paper.
Right.
By wiping out $1.7 billion of principal, they permanently destroy the associated interest expense. That means in Q3, Q4, and every quarter going forward, millions of dollars that used to go to bondholders now drop directly to the bottom line. It permanently inflates their future earnings per share.
So it is essentially a guaranteed return on investment equal to whatever interest rate they were paying on that debt.
Exactly. It de-risks the entire company. And when you pair that with a $250 million share repurchase, the signal to the market becomes undeniable. You do not buy back 3.2 million shares if your internal models show cash flow drying up next quarter.
Because buying back stock reduces the overall share count, meaning those future profits are divided among fewer shares, making each remaining share more valuable for you, the investor.
Management is looking at their newly optimized factory footprint. They are looking at their raised free cash flow guidance of $600 to $800 million, and they are determining that their own stock is the single best asset they can acquire right now. It is textbook shareholder value creation.
The narrative they are spinning is certainly compelling. Guidance is up, debt is drastically down, and gross margins are expanding. But, no earnings report is flawless, and it is our job to find the cracks in the foundation. Management explicitly flagged some very specific macroeconomic headwinds for the second half of 2026. This turnaround isn't happening in a vacuum.
Not at all. We really have to look at the macroeconomic tug-of-war playing out within their supply chain right now. Earlier, we discussed how the first half of the year got that massive 250 basis point boost from those IEPA tariff refunds.
Right.
Well, management is making it very clear that this temporary tailwind is over. In the second half of 2026, Section 301 tariffs will be enacted at levels equivalent to those IEPA rates.
So the duty costs on imported components are just snapping right back to where they were.
Correct. The structural cost of goods sold is going to increase. But it isn't just the return of the tariffs. Management directly warned investors that they are facing severe raw material inflation.
Which is tough.
Yeah, they specifically named 3 critical inputs that are getting much more expensive. Battery metals, tungsten, and oil derivatives.
Okay, let me use an analogy here for the listener. The first half of the year with that tariff refund was like getting a massive surprise tax return. You feel wealthy, your balance sheet looks great. But now, management is warning us that the fundamental building blocks of their entire product line are getting more expensive. It's like getting that nice tax return, but then finding out your monthly grocery bill is going up by the exact same amount indefinitely.
This raises an important question, honestly. And that analogy is exactly how investors should conceptualize the second half of the year.
Yeah.
The margin expansion they fought so hard for is under immediate threat from input inflation. And if you break down those 3 materials, you really see how heavily exposed modern industrial companies are to volatile global commodities.
Let's start with battery metals.
Battery metals are the absolute lifeblood of Stanley Black Decker's future. The entire industry has moved away from quartz. Their flagship products, the FlexVolt systems, the 20V Max platforms, they rely entirely on high-density lithium-ion cells.
Which means they need continuous access to lithium, cobalt, nickel.
Exactly. When global spot prices for those metals spike, the cost to manufacture every single battery pack they sell surges.
And tungsten. You don't usually hear about tungsten in consumer earnings reports.
Tungsten is critical for high-wear industrial components. If you are selling professional-grade masonry drill bits or, cutting blades that need to punch through concrete and steel all day long, you need tungsten carbide.
Ah, okay.
It's a non-negotiable input for the commercial and industrial products that carry their highest margins.
And then oil derivatives round out the trio. That obviously impacts global shipping and logistics, but it also physically impacts the tools themselves, right?
Exactly. The heavy-duty plastic housings for every drill, every saw, every battery pack, they are derived from petrochemicals. When crude oil rises, the cost of the raw plastic resins rises in tandem.
This brings us to the ultimate friction point then. Keeping this strictly to the financial impact, whether we were talking about Section 301 tariffs or soaring lithium prices, it all boils down to the cost of goods sold. Management has repeatedly stated a long-term goal of maintaining a 35% or higher gross margin. If every single input is getting more expensive, how on earth do they protect that margin moving forward?
It relies entirely on a really delicate balancing act between pricing power and volume. The fundamental question is, can Stanley Black Decker pass those increased battery and tungsten costs onto the consumer without destroying demand?
Right. Because if a contractor walks into a supply house and sees a DeWalt hammer drill has jumped by $40 because of lithium costs, do they still buy it? Or do they just delay the purchase or maybe trade down to a cheaper brand?
That is the big risk. If they raise prices too aggressively to protect margins, volume collapses. But if they eat the material cost to protect volume, margins collapse.
A lose-lose situation.
Exactly. The only way to win that tug of war is to outrun the inflation by finding even more operational efficiencies on the factory floor. They have to squeeze so much cost out of the manufacturing process through those footprint actions and supply chain consolidations that it completely offsets the rising cost of raw materials.
So to distill this entire deep dive down for you, Stanley Black Decker delivered a remarkably robust second quarter in 2026. The story is defined by a massive 620 basis point gross margin expansion, driven by ruthless manufacturing efficiency and aided by a one-time tariff refund. They are aggressively pruning the company, divesting their aerospace division, and licensing out low-margin mowers to focus strictly on what they do best.
And they deploy the capital from those divestitures perfectly. Trimming $1.7 billion in debt permanently reduces interest expense, while the $250 million buyback signals profound confidence from the executive team.
Which allowed them to raise their full-year earnings and free cash flow guidance. However, that bullish outlook is walking straight into a second-half buzzsaw of returning tariffs and surging inflation across vital materials like lithium, tungsten, and plastics.
It is a masterclass in controlling what you can actually control. I mean, no executive team can dictate global battery metal prices or rewrite international tariff structures.
Right.
But they can control their corporate balance sheet, they can dictate their product mix, and they can optimize their factory footprint. Right now, they are pulling every internal lever available to them to armor the company against external macroeconomic shocks.
Which leaves us with a final, slightly provocative thought for you to mull over. We spent time detailing how Stanley Black Decker is transitioning their legacy gas walk-behind mowers to a licensing model. It is a brilliant financial maneuver to boost margins, but it raises a fascinating existential question for the future of legacy industrial brands.
It absolutely does.
If a legendary tool company starts licensing its brand to third-party manufacturers, basically collecting royalty checks, rather than bending the metal, pouring the plastic, and building the physical product itself, where does the true value of an industrial enterprise actually reside in the 2020s? Is the ultimate value of the company found in the machinery on the factory floor, or is it simply in the intellectual property of the logo?
When you look at how Wall Street values high-margin royalty streams versus capital-intensive manufacturing, that is the multi-billion-dollar question every heritage brand is going to have to answer soon.
Something to think about the next time you are walking the aisles of your local hardware store and looking at the names on the boxes. That is all the analysis we have for you today. Make sure you hit follow on the show so you don't miss our tight daily earnings coverage and financial deep dives. We will see you next time.